Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax developments to the OECD's Pillar 2. I'm Doug McHoney, PwC's International Tax Services Global Leader. Check out PwC Policy on Demand's news platform that provides in-depth insights and analysis on tax policy developments. Policy on Demand is now available for free at policyondemand.pwc.com. On this week's episode of Cross-Border Tax Talks, we're recording from the Hotel Lobby Policy on Demand studio at PwC's International Tax Conference in Dana Point, California, where I'm absolutely thrilled to be joined by Pascal Saint-Amans. Pascal is a partner with Brunswick, a strategic advisory firm. Prior to joining private practice in October 2022, for 10 years, Pascal was director of the Center for Tax Policy and Administration at the OECD. Pascal joined the OECD in 2007, having previously spent nearly a decade in senior roles at the French Ministry for Finance. Pascal, welcome to the podcast. It's an absolute thrill to have you on.
Thanks, Doug. Very happy to be with you today.
I have done a lot of podcasts on Pillar 2, and I'm so excited to actually be able to talk to the source. And we've had a lot of partners and academics and some clients on. So it's really been quite a journey from the original G20 and OECD BEPS Project in 2013, and 10 years has gone fast. I'm sure you agree to that. The 15 action items developed during 2013 to 15, and the formation of the inclusive framework in the summer of 2016. But I want to focus today's discussion on Pillar 2. So can you spend a couple of minutes on the income inclusion rule and the undertax profit rule, kind of the origin story?
Yeah, I would like to say undertax profit rule. I mean, the acronym stands for undertax payment rule, but whatever P is fine. And you've just referred to BEPS. If I may, just for 1 second, say
Please.
that BEPS definitely, I think, is at the origin of Pillar 2. It started with Action 3 of the BEPS Action Plan, which was about strengthening CFC legislations. And the reason for that was that the US, and at that time it was Manal Corwin, who's going to be my successor at the OECD. She was in the room as the US delegate, and she said, we have a big issue with CFC legislation that we need to fix. And that originated the BEPS project, including this Action 3, where we failed. And interestingly, it's the US administration and Congress in 2017, by adopting GILTI, the Global Intangible Low Tax Income, which restarted the debate on a minimum tax. And we just took on this opportunity to say, well, we need to do something in addition to addressing the tax challenges of the digitalization of the economy. And that's where Pillar 2 in 2018 was born. And was delivered in 2021. So that's been the history of the project.
And I think that's very consistent with, and as a U.S. tax advisor, and we spent a lot of time on this podcast actually talking about GILTI and the mechanics of GILTI, and been fascinating to see how that's developed, particularly with the income inclusion rule. I am interested, you mentioned, because I'm not going to let, I want to mention the undertax profit rule, what I view as formerly known as the undertax payment rule. And there was a major change that was made that no longer required an actual payment for the undertax profit rule. Can you provide, is there a little insight into, because it seemed like a significant change for the architecture of the regime?
I'm not so sure that's a fundamental change, but to go back to the IIR and UTPR,
we can agree to call it the UTPR.
Absolutely.
All right.
So you asked about the income inclusion rule. That's GILTI. That's about this idea of strengthening the CFC legislation, which ends up with something quite arbitrary, which says below a certain level of effective tax rate, we're going to take the difference. The country of residence is going to take the difference. The UTPR is quite different from what the US did, which was the BEAT, right? Base erosion and high avoidance tax, right? For the acronym. I mean, the Republicans were very, very smart or astute or funny in the selection of the acronyms, right?
That is a common theme with U.S. tax policy.
GILTI and BEAT, that's pretty funny. But the BEAT was much more aggressive in a sense, arbitrary too. The undertax payment rule or the undertax profit rule, to take the right acronym as you say, is about making sure that Pillar 2 can be implemented and can have an impact, even if not all the countries move to implement it. And I think that was a very smart feature of the design of Pillar 2, which doesn't require that Cayman Island or the Bahamas or China or the US would implement for Pillar 2 to have an impact. And this was designed before the QDMTT came on the top of that. So I think the idea is to cover all types of payment, inbound as well as outbound.
Well, and that's fair. And I do think that the kind of underlying architecture that significantly changed when they went from the payments to the profit. And I think there's been a lot of discussion and debate, amongst academics, particularly from a U.S. perspective, as the U.S. thinks about potential implications of their tax base from a treaty perspective. And what do you say to critics of the UTPR, and particularly how that type of tax would fit within the global treaty network?
Yeah, that's been a question. This has been a question since the beginning.
For sure. And even with the beat as well, I will acknowledge.
With the beat as well, and there are interesting minutes in the conversations and what the JCT, the Joint Committee on Taxation, said on the beat's compatibility with tax treaties. So it's almost amusing that those who said, "Oh, the beat is fine," now are saying, "Oh, the UTPR is a problem," where it's quite similar. So the OECD has looked into that. When I was there, we looked into that, and I must say, there may be a debate, some may want to go to court. The analysis made by the OECD Secretariat as well as the governments was that they can move ahead. It's compatible with treaties, and I would say even more importantly, with the European Union legislation, with the rules, the principles of the European Union, because some said, doesn't work, and at the end there were some legal opinions saying, no, it does work, and you should go ahead. I recognize there is a debate, but this was decided by governments, so we'll see what courts decide, but the decision was made, and it was also decided not to go through a tax treaty or a multilateral convention to implement Pillar 2. And there was a debate, and the debate was decided in that sense.
Well, so in that context, as you look back and think about the process, any perspective on what went well as you think about this Pillar 2 process and have reflected since you've left for private practice on what went well, and then the follow-up question is going to be what could have gone better. But maybe start with what went well, because it's been quite a journey for you, and I know how much work that you and your team put in.
Yeah, it's been 10 years of extremely hard work. I mean, if we want to step back, we could go back to the harmful tax practices work in the mid-90s, 98, where the OECD issued a report, and there was this discomfort by some countries on the level of tax competition. But other countries said, tax competition is fine. We should focus on harmful tax practices. And that's where you had a number of criteria, in particular the ring fencing. The problem with that is a number of countries said, okay, if we're not fine ring fencing, we will de-ring fence. We will not do any form of ring fencing. And that increased tax competition. And that was the conundrum. A number of countries said it's too much, but by fighting it, they actually strengthened tax competition. And as a result, you had this weird behavior of a number of countries being more aggressive in the tax offer they were providing, general tax offer, not ring-fenced, and that called on the US reaction with GILTI and then Pillar 2. So what went well, to respond to your question, is it happened. I mean, that was not a given. Imagine 10 years ago that I would have said at a conference, we're going to have a global minimum tax of 15% effective. I mean, nobody thought it would be possible. It was like 20 years ago saying that bank secrecy would come to an end. Nobody would believe it. So it happened. And the fact that you have 137 countries which approved, actually it's more than that, because those, the Kenyans and Nigerians and Sri Lanka and Pakistan,
there could be others
which didn't join, actually they were supportive of Pillar 2. So everybody supported Pillar 2. So that's what went well.
And there are a number of countries that signed up, like the US, that probably will, at least not in the short term, be enacting. But a lot of countries, to your point. I think it was amazing and shocking to us that you were able to get, and the team was able to get, that number of countries on board.
Now that was, and Pillar 2 was not the most difficult. Pillar 1 was the most difficult to bring all the countries on board.
And arguably still is the most difficult.
It is. On Pillar 2, one of the very difficult countries was China, and we had to deal with China a lot, but they decided to join, I think, in a geopolitical environment where they didn't want to be a dissenting voice in the G20, which is interesting given the current state of play on geopolitics. What didn't go as well? The complexity. I think everybody agrees that it's extremely complex. Could we do better? I don't know. Maybe. The difficulty is that for the first time, and remember, we don't have a multilateral convention. It's about intricating all the tax systems together. That's difficult.
Right.
Imagine that you have to connect all the IT systems of 100 companies that you would buy at once. Extremely complex. And can you do simpler? I'm not sure. I wish it can happen. We wish so, and that's where the contribution of companies in the design of the implementation features is extremely important. The OECD is not looking for complexity for the sake of being complex, but just trying to accommodate the different constraints. So maybe more simplicity and providing more tax certainty is what is required at this point in time.
Yeah, and I think that's fair. And just one reaction to that is that these are complex problems and complex challenges. And so when we see this, these end up with complex rules.
And tax is complex, as a matter of fact. And if tax is simple, then it's extremely unfair and not sustainable. I mean, the simpler tax system in the world is a flat tax. And flat taxes don't fly well and very often result in revolution. So we need to be a bit careful. Complexity very often comes from the comments from business and the government to say, oh, but we need to adjust to this situation, to that situation. And in addition, as I mentioned, you need to interconnect all these tax systems. So that's why it's complex, but still, it's probably too complex.
You mentioned, going back, the harmful tax practices, and really wanted to ask you about, does this really make the system more fair? And maybe more specifically, will we see countries really just change the type of incentive regimes that maybe we've seen in the past that arguably started with low or no corporate taxes, and then a number of territories then raising the corporate tax rates and then having incentives, whether it's through rulings. We've seen a number of different incentives, like in the US with the R&D and something that was introduced, which is the qualified refundable tax credit, and now maybe even above the line deductions. So what is your answer to, is this make the system more fair? And particularly as we start to see countries that implement these rules, is this really just going to really change the game more so than necessarily change the behavior?
So first, we need to step back 1 second. Why did that happen? It didn't happen because of some crazy French guy being the tax director at the OECD. It happened because there was something broken in the system, which people were rejecting. And the people of the different countries rejecting it meant that we would lose any form of common rules in the world. And by the way, we've seen some of the consequences. I think tax is not alien to populism. The fact that the tax system was broken, that the fat cats would go away with no taxation, high net worth individuals and very wealthy companies. Why? Not because it was the aware decision of countries to provide for tax incentive or a system where they would be facing low taxation, but rather because the system was broken. Because the system designed by the League of Nations in the 1920s was no longer fit for purpose. And that's why there was a need to fix the system. So that's the first element. Second element, as regard the global minimum tax, it's a way to get rid of all the complexities of the hybrid mismatches and all the patches that the BEPS project brought. And maybe one thing which could be done in the future would be to remove the HTP rules, because now you have the safety net, right?
I think that's a very good question.
That's an open question,
right,
that we started reflecting upon when I was still at the OECD. Mm-hmm. So you have all these elements that you need to to take into account to decide whether it's fairer and more efficient than not. And I think it was inevitable to move there, or if we had not, you would have had more unilateral measures. I'm aware that there are many unilateral measures still, but the system would have really collapsed without this common effort.
As we think about kind of the development of these rules and the fact that 137 countries, or we'll see actually how many, but I don't think it's unreasonable to guess that we could get somewhere close to that. And even for those countries that don't implement, maybe there'll be other countries that didn't necessarily sign on to the agreement. But a common question that I get is the qualified domestic minimum top-up tax inevitable? In other words, countries that are offering certain types of incentives that may be kind of bad incentives, if you will, for Pillar 2, for those countries that have a lower statutory rate below 15, is it really inevitable in your view, and was that really part of the design, that most jurisdictions will just enact a qualified domestic minimum top-up tax to at least protect their own tax base?
It depends, but frankly speaking, it's more than likely. I was in Dubai a few days ago. That's what they are doing. They're introducing corporate income tax, but for the free zones, which are no longer free because now there is a corporate income tax, they will do a QDMTT. Switzerland is moving there. Singapore is moving there. Now, about the Caribbean islands, I don't know. And I guess the main question is, what kind of business will you lose if you put in place a global minimum tax, whether QDMTT or the income inclusion rule if you don't take it? And I guess countries are trying to figure out. Some countries think that the QDMTT will bring them money in the short term, but in the long term, they may lose some investments. So there is a dynamic scoring there, as you would say in Washington, right? Which has to be taken into account. But I guess a number of countries will move to the QDMTT. That would be my advice. And beyond the zero tax or low tax jurisdictions, you have a key question, which is the question of the tax incentives or the tax holidays in developing countries. Developing countries should think of this. Will they give it up to the capital exporting countries, or will they take it? And there is a difficulty, which is where there is a stabilization agreement through the investment agreements, they may not be able to take it, which may raise some geopolitical issues between these countries and the capital exporting countries. But yeah, I think we're moving towards the removal of the tax incentives, which is a fundamental decision, which was taken by the governments, by the US Biden administration, when they decided to go for this. And I'm not sure that all the governments and the companies have fully understood the consequences of removing tax incentives as a general matter.
And I think what you're alluding to are some of the green energy incentives, particularly the Inflation Reduction Act, but there are much more common examples like the R&D credit and other incentives. And it will be, I'm very interested to see how governments start to change their views on that, because I do believe that there will still be competition for foreign direct investment. And the question will be, how do countries try to work their way through the Pillar 2 systems?
And as you know, I mean, you have this criterion, which is refundable, non-refundable tax credits. That's the drawing line. And that was also a decision made after lengthy discussions. You try to exempt some sectorial exemptions or tax holidays, or do you go for another criteria, which is subsidies versus non-subsidies? And subsidies meaning that refundable tax credits can fall
into
that
above the line
category.
versus below the line. So one of the other challenges that I think taxpayers as well as advisors are going to face is that as jurisdictions start to implement rules, that the underlying rules may differ. I think that that's already been acknowledged by the OECD in a dispute resolution document that they issued in December. I think with the implementation framework that came out, we see that there could be potentially material differences in the qualified domestic minimum top-up tax, which there's really kind of less guidance. What do you say to taxpayers and advisors, and what is your view on how dispute resolution will work? Do you really think that there will be significant differences? Because it's not unreasonable to think that the base of a QDMTT could differ than another country's IR, which could differ than another country's UTPR. And while one would think that the qualified domestic minimum top-up tax should soak up, if you will, other jurisdictions who computed on a different base may think differently. How do you see that kind of playing out?
I mean, first and foremost, there is a need for a peer review. I think the OECD is working on that, and the peer review will be a way to minimize the risk, and I think all the countries have an interest into that. It's not like, the peer review on ending bank secrecy, where some countries may have wished that they would not be identified as not fully complying with the rules. Here, I think you have a common interest of all the countries to have a common understanding of what the rules are to minimize the differences. So that's the first thing. Will there be massive differences? I hope not, because of the peer review mechanism that everybody has a vested interest in getting functioning well. Two, there are still risks of differences and therefore of double taxation. And that's where I think the OECD has to be innovative in the way they will provide for mechanisms to limit double taxation or eliminate double taxation. And there, I will take another hat, which is the hat of professor at Lausanne University. By the way, I'm starting soon lecturing there. And my colleague, Robert Danon, has provided, with Guillermo Maestro, some proposals on how to address this risk of double taxation and how to put in place a mechanism which would draw on the existing mechanism but which may not require multilateral convention to be effective. So that's an area where I think the business community at large, academics and governments have to work hard, because now that we have a global minimum tax at a pretty high rate and an effective rate, you need to have a secure mechanism to avoid double taxation.
Yeah, I think one of the practical challenges that governments are going to have as they implement these rules to meet the timeline of January 1st, 2024, particularly for the income inclusion rule, is that the OECD, since you have left, has obviously introduced an implementation framework. But there's still a lot of questions that remain unanswered. And the OECD has said that there will be additional guidance that comes out. But there is a practical limitation to when the guidance comes out and when various implementing jurisdictions need to start their legislative process and get proposals out there. And so I think that the peer review process, that may be challenging for the peer review process, and that we have different sets of guidance as different implementing countries introduce their rules, could just ultimately lead to some significant differences.
And that's why the implementation of the UTPR is delayed by 1 year compared to the implementation of the income inclusion rule, precisely to adjust, because that's more complex. That's a more complex mechanism, a more risky mechanism, and that's why you have a 1 year delay, which will be 2025 for the European Union, which is the first to implement.
And as we think about that timing, as I've thought a lot about compliance, and we got the Globe information return, and we obviously, there will be some time right before actual forms are due. But we got the Globe information return, which really, in my view, is more a list of data points and really helping taxpayers understand, what information do they need by constituent entity. Was it your view, is it the OECD's view, and I appreciate you may not be able to speak for the OECD, that there will be one common form that will be filed? Is it, within that Globe information return document, they kind of reference that individual territories, but I think that taxpayers and frankly advisors that help with compliance were particularly troubled by the possibility that there could be significant different compliance requirements even if the tax bases are very similar.
So I will not speak on behalf of the OECD. I'm no longer there.
Yeah.
What I can say is that that's the aspiration. The aspiration is to have one common integrated system. And that's the beauty and the novelty of this, which is integrating all these different local systems into one, which is all the more difficult as technically it's challenging, and geopolitically we can see some tensions. Still, I think the aim to facilitate the life of taxpayer is to have one return or one consolidated set of data, which will draw, as you know, on the country-by-country reporting, refining and going one step further.
So I want to change gears a little bit and get your perspective on the U.S. side and how the discussions went with the U.S., because it's been fascinating to watch as a U.S. tax lawyer and somebody who tracks U.S. tax policy very closely. Were you surprised that the U.S. Congress did not enact country-by-country GILTI as part of Build Back Better? And specifically interested in, because we saw some of the public discussion, but what did the U.S. Treasury commit on that? And as you look back now at that process and the failure of Build Back Better, what is your perspective on that?
Well, the perspective is very simple. It didn't happen, right? Why it didn't happen, I don't know. I don't want to know, or I don't want to comment on that. But what's fascinating is that when we started working on that, Pillar 2 with the Biden administration, that's February of, which year was that already? February 21, right? Mm-hmm. We start working on that. And I think the expectation from the administration was that at the latest, in September, October 21, Build Back Better would be passed and that there would be a global minimum tax. And by the way, that's why we had the two-step mechanism. You remember? Agreement at the G7 in June, and then at the G20 in July with at least 15%, which was supposed to leave some room for maneuver to have a higher rate in the US possibly.
Right.
And then it didn't happen. And then it didn't happen. And then you had the IRA, which didn't include, I mean, there is something like a minimum tax, but not the one which was agreed at the OECD. Mm. The second perspective I think we need to keep in mind, which is extremely important, and I think the US business community may have taken some time to wake up to that, was that the US recognized, and that was, a decision, an aware decision, the US, this administration, decided that if they would not implement, other countries were legitimate to take the UTPR on American profits abroad. And that was part of the agreement, which was quite unusual. In international tax, right, as well as in many other areas, the US is quite unilateral, and there the US was not unilateral. It was multilateral and reciprocal, unlike FATCA or unlike some other mechanisms.
Yeah, and you received a number of letters from US lawmakers while you were at the OECD. There was just, the US lawmakers continue to respond to the OECD, specifically about the UTPR and the concerns those lawmakers have. And I appreciate some of those lawmakers are in a different party than the current Biden administration, but frankly, I wouldn't expect something to be similar if
But that's interesting, because these lawmakers are those who passed the BEAT, right? Which is quite unilateral, not to mention GILTI. So there is something not amusing, but interesting, let's say, in these letters to say, oh, this is not acceptable, when actually that's what they did to the rest of the world.
And I think that is a point that has been issued, and I've heard, or has been made, and I think you've made that point before. But from a practical perspective, how do you think the U.S. is going to react? And you obviously have a lot of experience as at the French Ministry of Finance. We remember what happened when France issued their digital service tax and the reaction of the Trump
administration. They want to go back to that now, right?
Issued that's where I'm going. What do you think? Do you think the U.S. will, as first of all, as countries implement UTPRs, now if digital service taxes pick back up, are taxpayers, will a trade war commence? Is that kind of inevitable at this point?
I'm asking you. I'm not an American citizen, so I don't know. What's
I don't make the policy.
What's fascinating when you negotiate with the US, which I have, is that you negotiate with the administration, which has no power whatsoever on the legislative branch. And it's been the story of the US. And why is it so? Because the Constitution provides for this. And the Constitution provides for this for fundamental reasons, which is not too strong a government and the control by the people. So it's a fundamental feature of the American democracy that US partners very often forget about. So what's going to happen? It's within Congress. Is Congress in a position to change anything now? I doubt it, at least for the next 2 years.
Right.
That said, when you look at the situation, you have GILTI. GILTI is going to move to 16%. Mm-hmm. It's still global average, but the computation rules are such as it's more stringent, right, than Pillar 2. And finally, you have this provision in the IRA, which provides for some form of minimum tax, at least within the US. So the question is, how big is the gap? It may depend on sectors that I don't know. I don't have the granular information. But the delta, the difference may not be that big at the end of the day. So what's going to happen in the US, clearly speaking, I don't know. I don't expect anything happening there. Is it a big or massive concern? I think business may know better if they look into that. And I think that's the key message. They should look into that right now.
Well, I certainly am not a policymaker, but do have concerns that we will see a similar reaction as the Trump administration with, as the undertax profit rule comes in and potentially as digital service taxes. But I've been in private practice for 25 years.
The difference, though, is that you're probably right, but still, the US administration, it's the administration, agreed this set of rules and agreed that it had to be reciprocal. So the situation is different from DSTs, where you have a number of countries shooting on their own, while the US said you cannot do that. So I think there is an asymmetry there. Will it prevent Republicans or whoever from taking measures? I'm not sure of, but the situation is not the same.
So let's switch gears a little bit. I want to just a couple of questions to kind of end things, and particularly as somebody who's been, as I mentioned, in private practice for 25 years, and I've been an advisor the entire time, obviously work very closely with clients and taxpayers, and I know that's something that you've also been very willing to engage with over the process. What value has the private sector provided to this process in Pillar 2, and any advice that you have for taxpayers that want to continue to engage in those discussions?
I think for Pillar 2, the input has been quite important because it's complex, because it's very granular in the implementation, and the team drew a lot on the work that they did with the business community, with the public consultations, with some other forms of consultation where you ask companies about the data to make sure that you understand how it works, that you ask companies about the IT to make sure that it can be implemented. So the input from business has been important, and if I step back, I would advise, take it as you want, but I would advise that when business tries to prevent a policy from happening, the impact is very small. Yeah. And actually, it kind of undermines the position of business, because it looks like protecting vested interests. When business is focusing on get the implementation right, then it's listened to. But by the OECD Secretariat, but that doesn't matter that much. What matters is by the countries, by the European countries, by the emerging economies, and by the others. So my advice is speak to countries. Don't even try to say this policy is bad when the policy is decided. I mean, of course, you may want to express your view, but you really need to focus on getting the design features of implementation right.
And I think that's my experience is that, you know, companies as well as advisors understand that how the winds are blowing and that things are changing. And you're right that of getting the implementation right is very important, because to your point, the complexity could potentially cost companies, you know, a significant amount of money. We think about some of the things that we've talked about, like dispute resolution. It's very much in business's industry to help make sure that those are consistent, and there are mechanisms to try to manage the complexity, manage dispute resolution, and obviously ultimately manage double taxation.
And you need to understand that governments are not looking for complexity for the sake of complexity. Sometimes you have some delegates who don't care, that's it. But you have, I mean, the majority of the delegates care about that, and they're looking for advice to get it right, and that's where business can useful input.
So the last question I wanted to ask you and give you the opportunity to kind of address the fact that you're now in the private sector. So what is your response to critics that you're going to potentially profit as an advisor from the complex rules that you were involved in implementing?
That's a very simple answer. I'm not doing tax advice in my practice. And that was, I mean, an important decision for me to take, because there is written tax on my front end, and everybody thought I would go to provide tax advice. I'm not. So I can help companies communicate about their tax affairs. It's not about complexity. It's about the relationship to society, the contribution to society. So it's a complete different angle, and I will do little tax and a lot of critical issues, advice in my new practice. So I think that's an easy way to answer the revolving door criticism, which I think I unfairly faced.
Well, and that's why I wanted to give you the chance to actually respond to that, because I do think.
No, thank you. I think it's important to clarify. I've joined a communication strategic firm, not PwC.
Right. Well, thank you very much for coming on. This has been an absolute pleasure. I've really enjoyed being able to pick your brain, learn a little bit more about the process. And while you will not be practicing tax, I will be spending probably the duration of the rest of my career, which is
Pillar
still
2.
On
Good
Pillar
luck.
2.
Sorry about that.
And I have spent a lot of time traveling around the globe and helping PwC as well as our clients start to prepare for this. And it's a very big challenge, and frankly something that I honestly didn't think that I would see during the course of my career, a true global tax base. And it certainly provides challenges for taxpayers as well as for advisors. But I really appreciate you coming on.
Real pleasure, Doug. Thank you.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Pascal Saint-Amans, Brunswick partner and former director of the Center for Tax Policy Administration at the OECD. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.